So home prices have slid yet again here in Ada County. Hey, what's up? It's Benj here with Triple Cord Real Estate, and I have a full market update for you once again, all the facts and the figures. I also did a bit of research on where Boise sits in relation to what is happening nationally. And then at the end, I also have a few comments to share from you, with you from an economist that I like to listen to as to what may be in store for us in the coming months and looking into next year. So be sure to stick around for that. So the median price fell once again this past month. We're down to $525,000 here in Ada County, which is down 6.5% since October. Now, year over year, and this is interesting, we're actually down. We're down 2.39% year over year, which is the first time that we've seen a year-over-year loss since 2014. Since the peak in May, the median has come down 12.8%. We were at $602,250, and now we're at $525,000 here in Ada County. Now, let me break that down even a little bit more for you. The median price for existing homes has come down even more than the overall median. Existing homes median price is about $497 now, and that's down $3,000 from October, from the month before. But we've seen a 15.3% decrease from the peak in this past May. New homes prices go down slower. And that's usually because builders don't like to drop their prices as quickly. They usually don't have as strict of a timeline as private homeowners do. So the price for new construction usually stays up a little bit longer. We've seen about a 9.68% decrease from the peak in May. Now, interestingly, that's a drop of $34,000 in 1 month. And I've actually seen that myself. I've seen home prices drop for new construction more than we normally see. I have some clients right now actually who just purchased a new home, and they were able to get it under the list price. Now, interestingly, the MSI, the month supply of inventory, is also slowly coming down. So even though house prices are dropping, we're also seeing a dip in the overall inventory on the market. Currently, we're at 2.47 months, which is down from about 2.6 months back in October. Now, for existing homes, we have a little bit less supply, about 1.9 months of inventory for existing homes, and then new homes a bit more, 3.2 months overall here in Ada County. Now, the reason for the drop in the month supply of inventory is not because we've seen an increase in sales. We've actually seen a decrease, as I'll mention here in a second. But it's because we've seen a drop in the total number of listings. Back in July, we had about 2,400 listings on the market at the end of the month. August was about the same, September 2,420. Since then, we've seen the number of listings drop. We're at about 1,450 homes for sale on the market now, which is the lowest number since we've seen since May, since the peak. Year over year, though, we're up about 131%, so quite drastically. And again, that's because last year we had a historic lows of the total month supply of inventory on the market. So because there are fewer listings overall, we're actually seeing the month supply of inventory slowly go down over the past several months. Now, sales volume is also down, as I'm sure you know, down about 39% here in Ada County year over year. Existing home sales volume is even lower than that, almost 45%, 44.9% drop year over year. And new homes, we've seen about a 19.2% drop year over year. Now, the main culprit for this is the drastic rise in the interest rate that we've seen over the past year. As you know, I'm sure, the interest rate has more than doubled, actually, and that has simply led to a number of buyers sitting on the sidelines, either because they've been priced out of the market or because there's a certain fear factor and they just want to wait to see what will happen with the housing market to see if it will stabilize anytime soon. And as you can imagine, that also has caused a rise in the average days on market. We're currently at 47 days here in Ada County, which is up about 5 days from October. Year over year, we're almost double. Last November 2021, about 29 days on average. Now, I had lunch with a lender a couple days ago, and we were talking about what is happening here in the Boise housing market. And sort of off the top of our heads, we were saying that it feels to us like house prices have dropped more drastically in Canyon County than they have here in Ada County. So I did a bit of research on that, and I actually found that actually is not the case. The median price in Canyon County, Nampa and Caldwell, is $415,000, which is a 12.9% decrease since the peak in May, where the median was $516,052. Average days on market in Canyon County is higher than it is here in Ada County. 59 days, which actually is up 10 days in 1 month. I thought that was interesting. A month supply of inventory, a little bit higher in Canyon County, 2.67 months, which is down from 2.84 months the month before in October. And then sales are also down in Canyon County as they are here in Ada County, about almost 34%. So 33.5% year-over-year decrease in the total volume of sales. Now, if you put those side to side, you can see that Ada County and Canyon County have seen really the same numbers when it comes to the housing market. The medians come down 12.8% in Ada County, 12.9% in Canyon County. Sales down 39% year-over-year in Ada County, 33%, so slightly less in Canyon County. A few less homes on the market overall in Ada County, about 2.4 months supply of inventory, whereas Canyon County has 2.67 months currently. Days on market, about 12 days less in Ada County, slightly easier to sell your house here in Ada County. 47 days on average, whereas in Canyon County, that number is at 59. Now, I think it's important to note that what we are seeing here in the Treasure Valley, in the Boise housing market, is not something that is unique. Across the United States, the housing market has really taken a toll over the past year or so. The Association of Home Builders conducts a poll every month where they survey home builders and they ask them what their confidence level in the housing market is. And then they have a scale where they rate, what the confidence level is across the United States. The current reading for November of 2022 is 31 points, which is a drop of 2 points since the month before. And that's the lowest reading that we've seen since 2012. So home builders are not really pumped about what they're seeing across the United States in the housing market sector. And you can see this graph that I found here. You can see that the home builder confidence has really nosedived over the past year. What that has caused the home builders to do is really pull back on the number of homes that they're beginning to build. So the house starts across the United States is down 22.4%. So they're building 22.4% fewer homes across the United States. And that's the lowest number of house starts in the United States for the past 2.5 years. Now, I think it's going to be interesting to see how this will affect the housing market long term, because if you've been watching any of my videos or you've paid attention at all to the news, we have seen a massive shortage of homes across the United States over the past 10 years, really. And really, that is why we had this, one of the reasons why we had such a massive increase in home prices over the past 5 years is because in the wake of the housing market crash in 2008, home builders really hit the brakes and they virtually stopped building homes for the next several years. And because the population was expanding, we had more home buyers entering into the housing market sector. We just had a massive shortage of homes. And when you have too many people looking for too few of homes, that's just going to drive up the prices. So the housing market has really taken the brunt of the Fed's crazy rate hikes. As you know, if you've watched any of my videos or you paid attention at all to the news, the federal interest rate was 0% basically at the beginning of this year. And the Fed has aggressively raised that rate up to 4.25%. And eventually that trickles down into the mortgage interest rate, which is why we've seen mortgage rates double over the past year. So because people are sitting on the sidelines, home sales across the board are down. They're down about 35% across the United States, which is the 10th consecutive month of sales volume decline in the United States. Now, it's interesting to see how the numbers compare in the different regions across the United States. The West has actually been hit the hardest in the housing market sector. Let me break that down a little bit for you. In the Northeast, sales have been down about 28.6% on average, but the median has gone up 3.5% year over year. In the Midwest, sales have been down a little bit more, 30.6% on average. Median has gone up slightly more, 3.9%. In the South, sales have taken even a greater hit, down about 35% year over year, but the median has gone up even more, on average 4.4% gain year over year. But look at that number for the West. The West has taken the largest hit in total volume of sales, down 45.7% year over year. And the median has come up the least as far as all the regions of the United States are concerned, about 2% year over year. So where will all of this lead us? That's the question that everybody wants the answer to. I think the first question that we need to answer is, has inflation peaked? Now, as I've been saying over the past several months, there are some indications that inflation is slowly coming down. If you followed the recent CPI reports, you see that the inflation numbers are coming down. They're not to where we want them to be, but we can see that prices are coming down. Just look at the gas prices, for instance. In Idaho, gas prices are down about 50 cents over the past month. So we're seeing prices slowly come down, and that is an indication to some economists that we're headed in the right direction. If that is the case and inflation has peaked, then we should see the interest rate come down, which actually is what we've been seeing as well. At its peak, the interest rate on average was about 7.08%, and that was about 6 weeks ago. The average today is 6.32%. And for some borrowers, that's going to be even lower. I just had a client lock a couple weeks ago, actually, at 5.99%. So we're moving in the right direction. The numbers indicate that inflation has peaked. Mortgage rates are starting to come down. But what's going to happen in the next coming months and the next 6 months and the next year? Now, that's the question that everybody wants to know. And I have a little picture of a prophet up there. I'm not a prophet. But let me just mention a few points that this economist Lauren Yoon made just recently. A couple things to take into consideration. Number one, the labor market that we are seeing today is actually very strong. In 2008, there were 8 million job losses in a single year. Now there are virtually none. Now, yes, tech companies and the mortgage industry are seeing some layoffs, but it hasn't been enough to actually amount to a net loss in jobs across the United States, and that's good news for the housing market. Number two, lenders are actually giving out way less risky loans. In 2008, you could get a loan without verifying your income, so a very risky loan. Today, those loans are virtually non-existent, so lenders are giving loans really to people who have been verified and who are qualified. Three, across the United States, we have a national shortage of homes. There's massive underbuilding. We see inventory shortages in all the regions across the United States. The same thing is true here in the Treasure Valley. But prior to the 2008 crash, there were about 7.65 million new home starts per year across the United States. Today, that number is down to 4.6 million. So even though we've seen an increase in the total number of buyers in the United States, we're actually seeing fewer new home starts. So that means we don't have this massive oversupply of homes like we did back in 2008. Four, very few people, relatively speaking, are delinquent on their loans. In 2008, about 10% of mortgage borrowers were delinquent. Today, that number is at 3.6%, which is a historic low. And then finally, the number of foreclosures across the United States is very low. During the last housing crash, about 4.6% of homeowners foreclosed. Today, that number is at 0.6%. So we're not seeing anything like we saw back in 2008 as far as foreclosures are concerned. So does that mean that I know the future? Obviously not. Nobody can predict the future, and it's incredibly difficult to actually time the market. But I do think that it's interesting that economists are looking at the economy and they're saying that we are not in the same economic position that we were in back in 2008, just before the housing market crash. And here's how Lawrence Yun summarizes where we are currently right now. He says, overall, the fundamentals don't point to a housing market that is operating similarly to the 2008 cycle. So I'll let you decide if you agree or not. But in the meantime, don't forget to tap the like button, and Merry Christmas.